Hey, what's going on? It's David Heller. I'm back. We're filming this in the beginning of February 2025. January was a bit crazy, so I think we were only able to get one or two videos out. But in this video, we're going to continue part two of our life insurance video series, where, in the last video, if you remember, we talked about the most important step of the life insurance planning process, which is determining how much insurance you should have or having some sort of baseline on how to figure that number out. We talked about, yes, going out and sort of just picking a random number and or saying, you know what, I need one times my total comp or two or three. It's not, bad by any stretch. However, we think more of a specific approach is really the way to go about it. And what I mean by that is figuring out what your expenses are, your assets, and then minusing that against your liabilities to figure out what the right amount, or having just some sort of idea in terms of guiding you to the appropriate amount of coverage that you should have in place. For this video, again, we're going to focus on the product side of things, which is really the part that most clients start to gravitate towards first whenever we're having these particular conversations. And again, we're going to just focus on term today and just take you through how it works, how do you structure it, or how can you structure it, and even a lot of the considerations that you should be thinking about as you go into the buying process for a policy like this. As we do with all of our videos, what we strive to do is be different than a lot of the other videos that you're going to see on YouTube or some of the things that you're going to read out there, and leverage our experience in doing this for many, many years as a firm and also as individual advisors, and give you what we're hearing from clients and a lot of the common questions they will bring up, but also marry that with a lot of the behind the scenes things that you might not necessarily think about or consider or think is a big deal. And also how a lot of life insurance salesmen that are out there are positioning the product to you and how to think about it. Okay, so what exactly is term life insurance? How does it work? Let's look at a simple visual. We call this our life insurance 101. I think this is just a good visual representation to explain at a high level how term life works and how you can structure it and what your options are. So going back to what I was saying before, what exactly is term life insurance? It's a type of life insurance product that will allow you to cover and put death benefit and protection in place for a defined period of time. So, say 10 years, 20 years, or even 30 years. If the policyholder, say, decides that they need $5 million of life insurance, like you see here in this example, they can go out and buy that amount of coverage for whatever selected period of time that they want to have the protection for. So, the death benefit is going to remain level. And what I mean by that is it's going to start at $5 million and end at $5 million. The death benefit will be paid out to the beneficiaries tax free. So let's just say you had a 20-year policy, you die in year 10, that $5 million policy will get paid out to the beneficiaries tax free. That's a very common question that we get from a lot of people. They'll say to us, hey, is it a taxable benefit? Is it a tax free benefit? So it is a tax-free benefit. Now, let's just say you had the same 20-year policy and maybe you died in the 22nd year. Obviously, the policy will no longer be intact, or in force is really what the industry calls it. And so if you died in that 22nd year and you had a 20-year policy, there's going to be no benefit to the beneficiaries. So going back to duration, as I mentioned before, you can select either a 10, a 20, and even a 30. Most carriers have either a 10 or a 20. I think 20 seems to be the most popular option, even though a lot of times clients will heavily look at a 30-year policy, but it is going to be a bit more expensive because you're buying a longer duration for the policy. There are some carriers that do offer a 15 and a 25. But there's really not many carriers out there that offer that. But it is nice because if you remember also in our last video, we talked about laddering your policies and your insurance coverage. So giving that extra option makes that laddering even more obtainable. But just know that, 10 and 20 are the most popular. 30, there are carriers that are out there that do it, but not as much as it's 10 and 20. And then there's some 15 and 25-year options as well. Premiums for these policies, and this is important, will most likely be level again. So that means that you buy that $5 million policy and maybe it costs $2,000. That premium is going to stay the same over the period that you own the policy for. So again, if it's a 20-year policy, that's how much it's going to cost and it's never going to go up. However, There are some policies that you can buy that are called annual renewable term where they're adjustable. So the premium is going to increase every single year that you have it. It actually, you could keep it until age 85 on average, depending on the carrier. I mean, that's generally how long it will go out for. However, the premiums are going to start out very low. So if that $5 million policy was $2,000 per year, maybe an annual renewable term is going to be 1,000, but it's going to go up a little bit every single year in cost. And then once you cross like that 10-year sort of marker, it starts to become progressively more expensive. So this is a big tack that I see from a lot of life insurance agents that are out there. They'll say to their clients or the person that they're working with, "Hey, you know what? Just buy this policy now. You'll pay less, and then you'll have enough net worth at some point in time where you won't need the policy, or you can convert it to permanent insurance," which is another topic we'll talk about later on. And so, while I think that everything within the financial world has, especially from a product perspective, has its time and its place. It's not saying that it's bad. However, if you do the math and you compare, say, that increasing premium product side by side versus a level product over, say, a 20 or even a 25 or 30-year term, you'll see that the amount that you're going to pay in the increasing premium product is going to be probably 2 to 3 times higher than what it would be in a level product. But it's enticing to see that less expensive number up front. And also, what I see happens a lot of times is clients will take that increasing premium product, so they have the less expensive premium, and as we all do, you kind of get going with life, and you don't necessarily do reviews or look at your life insurance as you much, say, like an investment portfolio. And then it's, 10, 12, 15 years later. And now that policy's gotten much more expensive. And it's even higher than maybe what you could even get at that age as being someone who's 10, 12, 15 years older. But maybe things have changed for you as well, as from an underwriting perspective, where it's a little bit harder to get insurance because you've had some health issues or you take some medications that insurance companies don't like. We'll get into all of that probably in the fourth video. But, these are things to just be aware of. Again, I'm not saying it's good or bad. That's just something that I commonly have seen from working in the industry for a while, and reviewing other policies from prospective clients or people that are even clients, that had another relationship before they become a client of Sandra Smith. So all in all, when you kind of look at everything, I mean, term is just a great option. It's typically the default that you get when you're, working with someone, especially like a younger individual who is either starting a family or just had their first kid, or maybe they have a kid or two, but just haven't got around to life insurance planning process. And again, maybe they just haven't generated a lot of their assets and don't have a large balance sheet. We talked a lot about that also in the first video. So when you look at the mathematics behind that, it typically will tell you, hey, you do need a good amount of life insurance coverage to basically satisfy all of the goals and objectives that maybe you want to cover. So term insurance is really just a great option, and generally will be the majority of what, if not all, what somebody would hold in terms of overall coverage, because it allows somebody to go out and buy large blocks of life insurance for typically a couple $100 per year per million. Again, that's very dependent on age and health class and gender. But again, that's another conversation for another day. But just know that term is a very budget friendly product and strategy to use when trying to solve for something like this. Also, another thing that you'll hear a lot of times, or a big question you'll get, is because people have been out there and they've heard about whole life insurance and, cash value insurance. So, that's a completely different conversation, which we'll address in the next video. But with term life insurance, it's just straight insurance. So there is no equity component that is slowly accruing throughout the policy. It is just straight insurance. So you pay that $2,000 a year, for example, for that $5 million policy. No equity is built in. It's just a straight 2,000, and it's covering you for that period of time for that death benefit amount. So sometimes what you'll hear people say is it's basically like renting insurance. That's a big term that a lot of life insurance agents will use. Okay, so now that we've gone through and explained how term life insurance works at a high level, let's talk about some of the other factors that play into buying a life insurance product, whether it's term or even whole life. But again, this will be a little bit more focused on the term side of things, but they kind of build on each other. So just go with me on it. Okay. So the first thing I would say is understanding the agent's role in the whole process. So when you're going through the buying process, there's two different kinds of people you can buy these policies from. You can buy it from a captive insurance agent. So they're going to be someone who represents a specific life insurance company. And in most cases, they're selling their own company's product. They might have some access to other carriers, but it's going to be limited. And they're really more incentivized to sell their own carrier's products versus another carrier's product. So you can kind of look at it as maybe they're focusing more on their own pocket and what it's going to do for them versus yours and what's in your best interest. So just be mindful of that. So the other individuals that you can buy these policies from are what's called independent agents. And so independent agents are really like the polar opposite to captive agents. Independent agents have the full flexibility to go out and work with any number of carriers that they want. The only carriers that independent agents generally can't get a hold of are the ones that are captive insurance companies. And there's probably like two that I can think of off the top of my head out of maybe two or so dozen. So an independent agent will not have any sort of bias towards any specific carrier or product. They're just going to be able to have like a true evaluation in our eyes in terms of what's the best fit for you. However, with all that being said, while I probably seem like I'm slanted more on the independent side, I'm not saying that the captive side is bad for you. There's nothing wrong with that. And the companies that are captive companies, they have great products. So there's nothing wrong with that. I think it's just something that as you're going through the buying process, what we would suggest to just know in the back of your head and maybe ask the person about. A lot of times if you do ask them, they'll say, yeah, I can get any carrier. We have an open architecture system. A lot of that, in my opinion, historically speaking, seems to be a little bit fluff. But again, you have to go with your gut. It's just something that you want to have in your back pocket as you're going through this buying process to just understand that whoever is suggesting a specific carrier, it's the right one for you or the right product and structure for you. And then on top of that, again, this is in no specific order, it's carrier selection. So this is tougher. And there's a couple of components that I just want to talk about just so you're aware of. So a lot of times I've heard people say, hey, what happens if this insurance carrier folds? What happens to my policy? And how do I judge the carrier's strength as a company? So you can look at all the different ratings that are out there, like the Moody's and the Standard & Poor's and things like that. And they'll give you some sort of guidance. But unless you're really reading through that and understand it, it's going to be hard to make a determination on the financial strength of that company. Yeah, you can go online and check for reviews of the carriers and things like that. But I would say that, again, it's going to come down to, I don't know, maybe just a little bit of homework, question asking on your end of the person that you're buying the policy from. If an insurance company were to somehow go out of business, there are safety nets in place. There's like an insurance guarantee association that is generally structured through the states that could help in sort of provide protection. Plus, usually from an industry standpoint, the proverbial thought has always been that other carriers will step in for the industry's sake and sort of absorb some of those companies and buy the different blocks of business that they have in place. So I wouldn't ever have the feeling that, the policy will never pay out. And also the good thing with life insurance is it's not like long-term care or disability insurance where the insurance carrier can say, hey, yeah, we're going to deny this claim. I mean, you're either alive or you're not. So I wouldn't worry about, speed of payment or being denied of payment or anything like that. But one huge thing that I do want to say on carrier selection is, and I think that this is important, and you're only going to get this if you've been in the business a while and dealt with many different insurance carriers. There's definitely carriers out there that seem like they've got their shit together. And, when you call into them and ask them for help and service and things like that, you get answers pretty much right away, or you get directed to the right person. And then there are some other carriers where you call in, you look for sort of direction in terms of whatever it is that you need to help service the policy in your client, and they're not in the US, or and they have no idea what you're talking about, or you get bounced around to multiple different people without really getting an answer. I've seen a lot of weird situations. I think the most common and frustrating thing from our side that the client isn't going to necessarily feel, but they sort of will feel, is if you're doing any sort of estate planning where you're going to be putting that life insurance policy inside of some sort of trust. Well, in order to do that, it requires a bunch of paperwork that the person who's servicing the policy for you, either the insurance agent or an independent agent, is going to have to go out and get, and then have you sign off on, and also the trustees and whoever is part of that particular trust. And so those particular, it's generally a couple forms, but they're very detailed and confusing. And each carrier, their forms are a little bit different, and they will kick back those forms if you complete them, have them signed off on, but a box is missing or something's not answered correctly. And it can be frustrating because you could call in and think you have everything you need in terms of what that carrier needs, have it signed off, send it in, and then it gets kicked back. And, rectify the situation or ask for something, again, a lot more trust related. I find they might not even know some of the answers. I've had that situation happen with some carriers that, again, I'm not going to mention anyone specific, but it is something to think about in terms of what carrier to go with. And again, it's going to be hard as the consumer to make that distinction, but, do your research as best as you can. And I guess, kind of lean on that individual who you're working with, and, kind of hope for the best, really. One other consideration too, just in terms of from a topic level, is policy conversions. So a big part of what you can do with a term life insurance policy is you can actually convert some of your term insurance into permanent insurance that a carrier will offer. So a carrier is going to have different products that they offer, both on the term side and also on the permanent insurance side. So that means whole life or variable or index universal or just universal life, depending on the carrier, because each carrier is going to have some, especially on the permanent insurance side, there's going to be differences in terms of a whole life carrier versus a variable, a carrier that does variable and index. Usually it's considered that mutual carriers have really strong whole life products, and stock companies have better variable and index universal and universal life products. Some of those stock companies don't even offer whole life products. Most policies that you buy will have some sort of conversion option already built in. It's nothing that you have to add on to the policy or do anything from that perspective. However, some policy conversions are going to be different. So you just want to check that out. And having the ability to convert is a nice thing to have. That way, if maybe from a financial perspective, you get to a point where you're making a little bit more money and you decide, hey, you know what, I do want to have some permanent insurance for the long haul. And, it's not necessarily a cash value play, or maybe it is a cash value play and you just didn't have the money. There's so many different ways that you can look at it. Or maybe your health changes and it's not something that is going to harm you and prevent you from living a long life. But it's always going to be there, and that you're never going to be able to get life insurance from an underwriting perspective. Again, having that ability to convert to permanent insurance is a nice option to have. So what I'm trying to say is that some companies have the option already built into a policy where you have 10 years to convert any portion or all of the term insurance over to any permanent insurance product that they offer. You'll be able to convert whatever it is that you want at the attained age. So let's just say you bought a term policy at age 35 and you want to convert when you're 35 and you got the best health class when you went through the underwriting process. When you go to convert that policy and you're now age 40, they're going to give you, you're not going to have to go through an underwriting. You're not going to have to give blood, urine, or go through the whole application process. You're just going to be able to convert whatever you want to permanent, and they're going to give you the best rate at whatever age you are when you buy that policy. Make sense? However, some carriers will have a shorter time frame that they'll give you the ability to convert a policy into, and also limit the products that you can select. So it might not be what's considered to be maybe one of that carrier's best products. It might be one of the carrier's kind of least bought product. So you want to, that's an important option. A lot of insurance agents will talk about that up front because they want you to convert over to permanent insurance. That's also another reason that the adjustable policy or the increasing premium product policy gets pushed so much by a lot of insurance agents that are out there, because they want you to convert as soon as possible to that permanent insurance, and they kind of build you up for that. What you need to understand as well is that there's going to be certain riders that you can select on a life insurance policy. Probably the biggest one is going to be the waiver of premium. So that just enables you to add on for maybe an extra $100 or $150 to $200 per year per million if you were to be ill or injured and you couldn't work on a full-time basis, the ability to not have to pay the premiums moving forward. But again, that's going to be an additional cost. Some agents routinely put it on, some don't talk about it, some will give you the option. So just know that it's out there. Ask the agent about it, and then make the best decision in your opinion. And then lastly, I mentioned level policies. I mentioned increasing premium products. Once in a while, a client will, or someone that, we're hoping to work with, will bring up what's called a return of premium policy. They kind of go online and they start doing some research on their end. And so, I rarely see people. I think I've seen maybe this policy maybe once, but I've definitely had people ask about it. And so what it is you'll pay your annual premium every single year. And then when you outlive that term, the insurance carrier will return the premium to you. The issue is that the premiums for those particular policies are generally 2 to 3 times higher than what a level or an increasing premium product would be. So, and not many carriers offer. It's few and far between. So with all that being said, that's just so you know about it, because again, people go down rabbit holes on various topics, no matter if it's financial planning, life insurance, investments, anything. And so we've gotten that question multiple times before. We just don't really see it be used. So that concludes everything, that I can at least, hopefully I didn't leave anything out. I hope this was helpful. I hope you took some notes. If you have any questions, feel free to email us. You can't leave any comments in the comment section of this video. Thank you, compliance. We love you. However, feel free to reach out to us through our website. We're more than happy to guide you in the right direction, give you an opinion, see if we can even help you. If you like this video, please give us a thumbs up. That helps us tremendously in terms of growing this channel and also finding out what people are enjoying and getting value from. And click subscribe so that way you can stay updated on any future videos that come out. We'll see you in the next one. Thanks. If you're ready to take your financial planning to the next level with a customized approach, feel free to reach out to us. This way we can help determine if we can even help you or even point you in the right direction. The best way to reach out to us is through our website at sandersmith.com. Thanks for watching. For more valuable tips on financial planning, check out those videos here. And if you found this information helpful, please like and subscribe so you don't miss any future content.